Good morning, everyone, and welcome to the Nedgroup Investments Global Fund Manager Workshop. My name is Anil Jagmohan, and I'll be your host for the first half of this morning's program. We're broadcasting live from Cape Town, and I'm really excited to be here today. We've got an interesting lineup and a great bunch of speakers here for you today. So it was quite an interesting quarter. So the MSCI World Index was up 6.5% or so, and the MSCI EM Index was up about 3.5% in USD terms. But the question is, well, what happens next? And to answer that question, I'll explain to you the great number of guys that we've got here today. So first up, we've got Marco Colantonio from Resolution Capital. Next, Ian Beattie from NS Partners. And then the last speaker in this segment is Stephen Romick from FPA. So without further ado, let me introduce our first speaker. Marco Colantonio is a co-founder and portfolio manager at Resolution Capital. Resolution have been managing global listed real estate portfolios since 2006, and they've actually managed the Nedgroup Investments Global Property Fund since July 2016, which means that actually as of last week, we now have a 5-year track record on the fund. And if you consider relative to the Morningstar European peer group, the fund is actually sitting in the top quartile since inception, which I think is a great place to be to spend your 5th birthday. So without further ado, let's hand over to Mark. Thanks, Mark.
Thanks, Anil. Good morning, everybody. For the quarter, REIT returns were actually quite strong, 9% during the quarter alone, which is largely reflecting, improved operating conditions for the REITs into a strengthening global economy. While interestingly, at the same time, we had bond yields actually coming down a little bit. We also had some M&A transactions in underpinning the REIT market. And generally, we saw a little bit of a reversal of the rotation theme that we had been seeing. So we actually saw some rotation out of value and back into growth. So during the quarter, as you can see on the bottom of this chart, that in terms of sectors, self-storage, hotels, and self-storage, residential, and industrial. Actually, this is a 12-month chart, but for the quarter, self-storage, residential, and industrial all demonstrated very solid pricing power, and that's critical in a more inflationary setting, and that was the thematic for the quarter. Beg your pardon, this chart shows you the 12-month returns, and you can see here over that longer time frame, the more harder hit sectors like hotels, retail, and aged care, seniors housing, all experienced some of that sort of reopening trade, which was kind of not the theme during the most recent quarter. Now, in terms of our performance for the quarter, we marginally underperformed after fees, with our exposure to data centres and healthcare outperforming, but offset by some negatives in office, particularly in Japan, and some of those reopening trades that rotated back into favour of value as we saw that inflation theme come out and lower interest rates, with some of the retail names actually underperforming during the quarter. During the year, look, we're not happy about trailing our performance during the year, but it is consistent with our longer-term investment philosophy of providing downside protection, given our preference for higher quality, strong balance sheets, and that does tend to trail when we see some of the more troubled real estate sectors like retail and like the highly levered REITs rebound strongly, as we have seen over the 12-month period. But pleasingly, over the long term, our excess returns remain intact. This slide shows you our rolling 3-year excess return over the benchmark, and it shows that point that we do tend to outperform by a greater extent during periods of distress. So you can see, in the period post the global financial crisis, 2009, 2010, a strong excess performance, and again early in 2020 during the pandemic, we outperformed, and then it does tend to revert as the market rebounds. But over the long term and over rolling 3-year periods, we do continue to outperform, but with downside protection. And this slide just shows you, in another way, just shows you the same thing more on an annual basis and on a monthly basis. We tend to outperform 74% of down markets and only 50% in up markets. In terms of the attribution over the last 12 months, you can see that retail has been a big detractor for us, as many of those distressed retail stocks, particularly malls that we don't own, like Unibail-Rodamco, which has very high leverage, and Simon Property Group in the US, which, in our view, US malls have too much retail space and just don't have pricing power. But they have rallied quite significantly from their near-death experiences of about 15 months ago. We still have concerns about those companies, and we retain an underweight to those companies. But in the snapshot period of the last 12 months, the other sector that has detracted for us was data centers, which have lagged that rebound in a relative sense. They haven't fallen in value, but they certainly had already been strong performers during the worst of the pandemic in February, March, and April of 2020, and so therefore they didn't participate in the rebound as much as the other stocks, particularly since the vaccine announcement. So in terms of changes that we've made to the portfolio over the last 12 months, you can see here that we have added a fair bit of retail to the portfolio, but more at the defensive end of the retail sector. So more grocery anchored open air strip centers in the US, and very selectively in the mall space. So the European and Australian malls, where the tenant mix for the shopping malls is much more diverse, and the supply of space per capita, retail space per capita, is much less in Europe and Australia compared to the US. You can also see we reduced our data center exposure, again, just reflecting the strong relative performance that they had achieved in the lead up to and during the worst part of the pandemic early last year. And similarly, some of the more defensive names we rotated out of, like in residential, based principally on relative valuation grounds. So let's have a look at how the portfolio looks today. And one of the things this slide really highlights is the diversity that's available in the global listed property sector. And it gives us the opportunity to gain exposure to a broad range of different property sectors that are relevant to the economy and leveraged to major secular or demographic growth drivers. So in residential, which is 21% of the portfolio, we have actually multiple different streams of residential that we can invest in. It can anything from single family homes, principally in the US, which right now are experiencing very strong fundamentals, as you see some shift, particularly towards the Sun Belt, and also a preference for millennials as they age, and also as people are working from home, they want larger homes. We also have multifamily, which offers some exposure to the improving jobs market as the economy reopens in certain markets, and manufactured housing, in effect another way of saying caravan parks, which is a very affordable housing segment. It often caters to seniors, but it also has some element of more domestic tourism that's benefiting strongly. And our exposure there, Equity Lifestyle Properties, just posted very, very strong results last night. In retail, you can see it's 17% of the portfolio now. That's much bigger than what it was 12 months ago. And again, just reiterating that it's much more selective exposure to what we think is the more defensive end of the retail segment, where particularly the open air strip centres have been sort of reassessed by retailers because COVID has really opened their eyes to the value of their store network as a last mile distribution hub, not just to deliver from the back of the store, but interestingly, click and collect. They've come to realise during COVID that click and collect was a very effective way of distributing their product and much cheaper than having to deliver it to their homes. Industrial logistics is 14% of the portfolio. E-commerce is a very strong driver there, and also supply chain reconfiguration. Healthcare is 8% of the portfolio. That aging demographic trend is coming to the fore, and you can see data centers and towers, as much as we have reduced it, but still 6% of the portfolio, catering towards that digitisation theme. Within office, there is an exposure to research and development and life science and lab space, which we find very, very interesting. So a couple of observations about the market. One thing that's been very obvious of late is that we've seen rising construction costs, and that's in part due to supply bottlenecks for materials and for that matter, even labour. So as we have an improving economy, you're beginning to see a spike in material costs and labour. And that's really important to understand those dynamics in the context of real estate in a rising inflationary environment, which has become quite topical, of course, across multiple asset classes. We've been getting lots of questions about rising interest rates and rising inflation and the risks for property. And I guess it's fascinating for us that, over the last 20 years, the narrative has been that lower inflation and falling interest rates in most parts of the world have been used to explain why real estate, has performed well. It's a tailwind for real estate, and the rising tide lifts all boats. And so the assumption is that when you see a reverse of those conditions, when you see interest rates rising, inflation rising, then that will be negative for real estate. Well, in our view, people are forgetting two really important factors. One is that if that were true, if the rising tide of low interest rates was lifting all boats, then why have we seen retail real estate really struggle over the last 10 years compared to, for example, industrial real estate? And the reason is good old supply and demand fundamentals matters much more than interest rates. So it doesn't matter if interest rates are falling. If you have weak demand, if you have rising vacancy rates, your real estate's going to underperform. And the second thing that people have been forgetting is that, when inflation was rising and interest rates were higher and rising, real estate was, 25, 30 years ago in many markets, was actually sought after as an inflation hedge. And again, same reason, supply and demand fundamentals. If inflation and interest rates are rising because of a strong economy, and because construction costs are rising, as we've already experienced, then as long as your real estate is catering to the sectors of the economy that are growing, then the developers and the landlords will be able to pass on those higher rents. It's obviously important that you have inflation being driven by economic growth. If it's not, then acknowledge that that's not good, but it's not necessarily just good, not good for real estate. It's not good for a lot of asset classes. So to us, the most important thing to bear in mind is the supply and demand. And right now, we are seeing a very strong demand as the economy improves, off of an occupancy rate that's been reasonably steady. And what COVID has done is probably just slowed supply quite significantly. The other thing that's really important to focus on is leverage. And the pleasing thing about the listed REIT sector at the moment is that leverage is pretty moderate. We're not seeing excessive leverage and the bad practices that we saw in the lead up to the global financial crisis. There are some stocks that we are avoiding because they have too much leverage, but it's not widespread. And the major growth themes that we're seeing at the moment were mostly present before COVID. And in fact, if anything, they've been reinforced by the pandemic. So, e-commerce is benefiting logistics, and that continues. And COVID has just reinforced that. Data centers and cell towers have been benefiting from the digitization thematic, and again, that continues. Life science laboratories have been performing very, very well, and that's been catering to a massive boost in R&D spending in the biotech industry. And many of the names that you're familiar with now and probably hadn't heard much of, or certainly not as often 15, 18 months ago, but Pfizer, Moderna, AstraZeneca, Johnson & Johnson, etc. They're all tenants in lab science office buildings that we can get exposure to in the listed REIT market. As I mentioned, we're seeing some M&A activity. That's a reflection of supportive capital markets, but also that real estate's trading relatively. The REITs are trading cheap to the real estate, and it's an opportunity for investors to get set in scale in the real estate market. I've mentioned a couple of times retail. It's important to be selective, and we think that there's opportunities within retail, but you do need to be very selective. And there's been a reassessment of some types of retail during COVID. And I'll flick through, because in the interest of time, the next couple of sectors to leave a little bit of time for Q&A. But turning to the outlook, look, there's no doubt about it. We are getting questions about the valuation multiples that do look a little bit elevated for REITs, but REITs are not alone in that space. Equities and bonds, as this chart shows, are also looking quite elevated on a multiple basis. That's a reflection of the growth potential from an improving economy. Overall, we think that REITs remain in relatively good shape. The fundamentals of supply and demand are relatively solid. There's not excessive amounts of construction. Construction costs are rising, which makes it harder for developers to make easy money. The global economy is improving, which should lead to further rising occupancy for many segments of the real estate market, and therefore there's reasonable prospects for rental growth. The balance sheets are sound, and as I said, M&A is beginning to occur, generally because the REITs are trading reasonably cheap to the underlying real estate. So global REITs provide us with a diverse opportunity set that we can position the portfolio to relevant segments of the economy that have structural growth drivers, as well as reasonable prospects for a recovery in earnings from somewhat depressed levels. And so real estate can perform in a rising inflation and interest rate environment, or even if we don't, they can still perform given those macro backdrop. So thanks, Anil, and with that, I'll hand it back to you for any questions.
Thanks, Marco. There have been a couple of questions that have come through for you. Let's see how many of them we can actually get through. The first one is just about your thoughts on the implications for self-storage, just given that probably more kind of office-bound people are moving out of the larger cities and potentially moving into bigger properties. So what would be the implications for self-storage from that perspective?
Yeah, so self-storage has been a very strong performer during this period. Any sort of dislocation typically does boost demand for self-storage, and as you quite rightly point out, there's the chance that as people move to larger homes, that might result in a decline in demand. Look, we expect that demand will taper off from what is currently record levels of occupancy. One thing is fascinating about self-storage. It's amazing, particularly in the US. People tend to put things into storage and never bring themselves to have that spring clean. They just accumulate more things. But having said that, we do think that that people that we will see some demand tapering off, and even if it doesn't, then ultimately, if conditions remain this strong, occupancy at record levels and strong rental increases, then you'll see supply and it will taper off. But we like self-storage because it provides a relatively good cash flow yield after capex, regardless of even if demand does taper off a little bit.
Excellent, thank you. And just maybe on your residential exposure, which is quite a big chunk of the portfolio, but specifically student accommodation, just what are your thoughts around that?
Yeah, so student housing typically very resilient during an economic downturn. So when you have the job market weakening, you typically see university enrolments picking up. So we initiated positions in a couple of stocks last year as the COVID unfolded and some of the stocks got hit pretty hard. And so they've been quite defensive and they've rebounded quite nicely. And so right now we're actually sort of reducing our exposure to those as we see better jobs growth prospects. But it's been quite a good contributor to performance over the last 12 months, given that the stocks were hit pretty hard. They performed pretty well. In fact, student populations are continuing to go to on-campus locations despite many of the lectures being online. The stocks have largely recovered, and we've begun to reduce our exposure.
That's all we have time for. We really appreciate your time. I know it's quite late there in Australia. And yeah, just thanks for the great performance. Take care.